Assalamualaikum and hello everyone. Today we're going to learn about fund accounting in chapter 5, but in textbook this topic is in chapter 8. You can turn to page 161 if you have the textbook. Okay. First we go through our learning objectives. At the end of this chapter, we all should be able to define fund accounting, determine the objectives of fund accounting. We should be able to explain the characteristics of fund accounting. We should be able to describe the regulatory framework and relationship between three types of consolidated fund. And the last one, at the end of this chapter, we should be able to categorize and explain the types of consolidated fund, which are consolidated revenue account, consolidated trust account, and consolidated loan account. According to Jones and Pendelberg 2010, fund accounting is defined as the accounting for each fund produces its own operating statement and balance sheet. Fund accounting also represents a system of financial record keeping that focuses on how an organization uses its finance. The fund accounting also used to record the source of fund and how the funds are being spent. Alright, next is the advantages or uses of fund accounting. Actually, this is very useful for the government agencies and local authorities. For example, government agencies and local authorities require a reliable and relevant financial accounting system so that they can track funds generated from various forms of revenue and the related expenditure that may comprises of projects or appropriation. Fund accounting is very useful also to isolate and assign certain assets so that it will meet a specific purpose. And then fund accounting also can separate all financial accounts into individual funds. Okay, next we proceed to the objectives of fund accounting. This is very simple. According to the textbook, you can turn to page 162. Very straightforward. I think we should be able to understand this directly. Objectives number 1 is the fund accounting is to determine the financial condition and its changes in the organization, and then to know the results of operations of the organization, and then the last one to check the compliance with legal restriction. Okay, we move on to the next slide. Fund. Actually, fund represents a sum of money allocated for specific purposes. There are three types of consolidated fund. This is very important because this is what we are going to learn throughout this chapter, these three. Number 1, consolidated revenue account, consolidated trust account, and consolidated loan account. What are the characteristics of fund accounting? Number 1, each fund is an independent accounting entity, which means the revenue, loan, and trust account can stand on its own. They can make decisions independently regarding the best use of its limited resources. Number 2, each fund has its own set of accounts with complete double entry and financial statements, which means the revenue, loan, and trust account, they have their own set of accounts without mixing with each other. Okay, and the third one is each fund must be self-balancing and autonomous. Self-balancing means The total of assets of a particular fund must be equal the total of its liabilities and fund balance. Meanwhile, autonomous, on the other hand, means that although a governmental unit may be composed of several different funds, the focus must be on general government activities and spending activities, where the crucial decisions, objectives, and goals can be identified. Okay, we proceed to the next slide about regulatory framework of consolidated fund. Okay, we are going to read clockwise like this. First, we go through Article 97, bracket 1 of the Federal Constitution. You can refer this in the page 162. Article 97, bracket 1 of Federal Constitution state that all revenues and monies raised or received by federal are to be accounted for in a fund called Federal Consolidated Fund. And then, okay, next, Article 97, bracket 2 of Federal Constitution is for state government. It stated there that all revenues and monies raised or received by a state shall be accounted for into the consolidated fund for that particular state. Okay. Next is Article 97, bracket 3 of the Federal Constitution. This is for Islamic related revenues like zakat, fitrah, baitul mal, or other similar religion revenue. These kind of revenues are to be paid into separate fund. Okay, but it shall not be paid out except under the authority of a state of a federal law. Next, we go through Section 7A to C of the Financial Procedure Act 1957. This section specifies the 3 separate accounts to be maintained in the financial priority in respect of the consolidated fund. Okay, Section 7, bracket A is for consolidated revenue account, and then bracket B is about consolidated loan account, and consolidated trust account is in Section 7, bracket C. Okay, we move on to Section 16, bracket 1 of the Financial Procedure Act 1957. This is about at the end of every financial year, the authorized financial authority is expected to prepare a number of key statements. The key statements is in the textbook also, including A full of particular statement of consolidated revenue account, B, a full of particular statement of the consolidated loan account, and C, a statement of receipts and expenditure of consolidated trust account. Okay, we move on to the last one here, Government Accounting Standards 3, 4, and 5. Okay, Government Accounting Standards, also known as Piawaian Perakaunan Kerajaan. These government accounting standards aim to set accounting policies and standards, as well as basis for financial statement presentations that have been complied with by the federal and state governments. Okay, Piawaian Perakaunan Kerajaan (PPK) number 3 here is about consolidated revenue account, and then PPK number 4 is about consolidated trust account, and PPK number 5, this one is about consolidated loan account. Okay, let's move on to relationship between 3 types of consolidated fund, but this one is just an overview of this whole chapter, because these 3 types of consolidated fund we will learn in depth, and that will be presented by our friend Rafidah and Zakia. So you can always go back here after you understand all of it and try to connect and see the relationship between these three. Okay, we go to first trust account. Actually, there are three under the trust account, which are deposits, public trust fund, and government trust fund. Housing loan fund, development fund, and clearance fund are actually under the government trust fund. Okay, you will see this on the next slides. And then the revenue. Okay, revenue. We actually got the government actually got revenue from tax, direct and indirect tax, right? So the revenue will be used to supply expenditure like operating expenditure such as emolument, services and supplies, acquisition of capital assets and subsidies, and fixed charges. So, and also this revenue also used to contribute to the government trust fund, housing loan fund, and development fund in the trust account. So that is how revenue account and trust account is related to each other. Okay, and then we go to loan accounts. Loan account, government got loan from internal loans and external loan. Okay, and then the loan that the government got will be used for the repayment of loans such as outstanding loans, but the loan also will be transferred into housing loan fund, development fund. Okay, so that is how loan account and trust account is related to each other. Okay, I think you will understand more in the next slides. Okay, that is all from me. Thank you and stay safe. Bye.
Assalamualaikum and hi, my name is Rafidah binti Mustapha. Next, I will proceed with the types of consolidated fund. The first one is consolidated revenue account. In Section 7A of the Financial Procedure Act 1957, all types of money or revenue received except for loans and trusts are to be accounted for in the consolidated revenue account. This money are used to maintain operating expenditure, which include charge expenditure and supply expenditure. Additionally, all money and revenue received by the government must be put into the consolidated revenue account except for zakat, fitrah, baitul mal, and other Islamic religious revenue. The next one is consolidated trust account. In Section 7C of the Financial Procedure Act 1957, consolidated trust account is established to account for all receipt and payment of trust fund and monies received by the government for a specific purpose. All receipt and payment of trust money should be accounted for and maintained in accordance with related act, rules, and regulation of trust. The consolidated trust account primarily comprises of government trust fund, public trust fund, and deposit. The first one is government trust fund. Government trust fund account for receipt from government allocation and payment for specific trust purpose in accordance with Section 10 of the Financial Procedure Act 1957. Some of these funds are revolving, meaning that the amount is not fixed. The three primary types of government trust fund. The first one is development fund, second one housing loan fund, and miscellaneous government trust fund. The first one is development fund. Development fund is a trust fund set up in accordance with the Development Funds Act 1966 with the key aim that is for the economic development of the nation. Receipt from this fund consists of loan for the purpose of development, contribution from consolidated revenue account, and repayment of loans given out from this fund. Transfer from the consolidated loan account represents the main source of the finance to the development fund. The second one, Housing Loan Fund. Government Housing Loan Fund Scheme (GHLS) is financed by the Housing Loan Fund (HLF) in accordance with the provision of the Housing Loan Fund Act 1971. And the last one, Miscellaneous Government Trust Fund. This trust fund accounts for specific trust purpose. Part of this fund is revolving in nature while others provide for outright payment. Financial sources of this fund come from appropriation from the government. The 5 categories account are clearance account, trading account, loan account, contingency fund, and miscellaneous fund. The second one in consolidated trust account is public trust fund. This fund consists of special trusts incorporated under the relevant Act and general trust. Financial sources of this fund are received from organization or individual for specific purpose. Private Finance Initiative Trust account is an example of a public trust fund used for development expenditure. And the last one is deposit. Deposit consists of general deposit and adjustment deposit. General deposit are monies received from specific purpose by the federal government for a specific purpose under any laws or contractual agreement. Adjustment deposit are temporary account used before payment are made to specific account.
Now we proceed with consolidated loan account. Consolidated loan account is established by the federal or the state government to keep all monies received by way of loan. The main sources of this account are from both internal and external borrowings. While domestic borrowings comprise of loans obtained from local banks and financial institutions, external borrowings are loans made from foreign banks and other financial institutions. The monies received from both of these sources of loans are accounted for and utilized primarily for the repayment of outstanding loans. Apart from that, transfers are also made to other funds, specifically the Development Fund, Housing Loan Fund, or other funds authorized by the Parliament. This which depends on the purpose of the loan was raised. For internal borrowings, the federal government continuously focuses on domestic sources for borrowing with the aim to finance the budget deficit and to meet the domestic demand for debt securities. The 4 main types of domestic loans instruments raised are the Malaysian Government Securities, MGS, Treasury Bills, TBs, Government Investment Issues, GIIs, and Sukuk. Malaysian Government Securities, MGS, represents the main source of domestic borrowing, and that they are in the form of bonds issued on a long-term basis to finance federal government expenditure. They are registered stocks made available to the market by tender and are managed by Bank Negara Malaysia. The maturity period is between 5 and 20 years. MGS continued to be the main source of domestic borrowings for the federal government in the year 2012. Second is Treasury Bills. Regulated under Treasury Bills Act 1946, which is revised in 1977, TBs comprise of short-term loan instruments issued by the government periodically to finance the redemption cost of matured bills. The maturity period is between 91 and 365 days. The main subscribers of TB are commercial banks and discount houses. Third, government investment issues. The IIs aim to meet the demand for government papers based on Islamic principles, as well as to complement measures in controlling excess liquidity in the financial system. GII are medium-term loan instruments with the maturity period between 1 and 8 years. The main subscribers of these investment issues are Bank Islam Malaysia Berhad and other financial institutions offering interest-free banking services in fulfilling their liquidity and investment requirements. Sukuk. Sukuk commonly refers to the Islamic equivalent of bonds. Sukuk securities are structured to comply with the Islamic law and its investment principles, which prohibit the charging or payment of interest. Financial assets that comply with the Islamic law can be classified in accordance with their tradability and non-tradability in the secondary markets. Malaysia had enacted the Government Funding Act 1983 with the aim to enable the issuance of instruments that could serve as liquidity management tools for the Islamic Bank through issuance of Sharia-compliant government investment certificate. In July 2013, the GII has been issued under the widely accepted Murabahah structure. Murabahah generally represents a certificate of indebtedness arising from a deferred markup transaction of an asset, such as commodity, mainly crude palm oil, which complies with the Sharia principles. Now we proceed with instruments of external borrowing. External borrowing is raised by the federal government from sources outside the country. The World Bank defines external loans as those loans which have original or extended maturity of more than 1 year owed to non-residents and which are repayable in foreign currency, goods and services. External loans or foreign loans are obtained with limits of borrowing based on the External Loans Act 1963. External loans consist of market loans, project loans, and Wakalah global sukuks. Let me see market loans first. Market loans are regulated under the External Loan Act 1963. It covers the loans obtained from international financial institutions which are negotiated at common market rates raised for general purposes. The general duration of borrowing time is between 14 and 20 years. The three primary types of market loans are syndicated loan, bond issues, and floating rate notes. Syndicated loan refers to a form of loan from a group of registered foreign banks. Generally, there are 20 to 30 banks grouped together which provide loans. The interest payable to them is based on the floating rate basis of LIBOR, yen, or the Swiss franc. The maturity period for this type of loans is approximately 10 years. Next is bond issues, are loans provided on an IOU method. The EU price is determined by market conditions of demand and supply, and the maturity period is between 5 and 15 years. Bond issues are loans largely obtained from the government in Tokyo, Frankfurt, Amsterdam, and Zurich. Lastly is floating rate notes represents the external loans where the interest payable is based on the floating rate with a maturity period of between 10 and 30 years. Now we look at project loans. Project loans are borrowings by way of money, services, and technical studies which are secured for specific development projects. It can be obtained both from multilateral and bilateral government sources. Examples of multilateral sources are the World Bank, Asia Development Bank, and the Integrated Development Bank, while bilateral sources may comprise of loans on government to government. For example, between Malaysia and Japan. Wakalah Global Sukuk. Wakalah Global Sukuk is one form of external borrowings for the Malaysian government to continue to support its prudent debt management practice. As stated by the Malaysia International Islamic Finance Center (MIFC), the Wakalah Global Sukuk is Malaysia's third USD-denominated sovereign sukuk issuance. The Wakala Global Sukuk is the first 10-year global sovereign USD Sukuk for 2011. Structured under the Sharia principle of Wakala, largest dual-tranche global sovereign USD Sukuk ever issued. It established a new benchmark in the Islamic capital market.